It's not about how much you have, it's about how much you keep. And it's about how much income what you have produces for you without you having to actually do anything. That's what generational wealth is. Within the two different types of real estate, right, residential or commercial, there are a whole bunch of subcategories. There's really almost 3 categories of residential property. You have single-family residence, up to a 4-family multifamily residence, which still gets residential treatment. And then you have the huge multifamily, right? 5 units and above, 100 units, 1,000 units, whatever it is. Multifamily housing is considered a great asset class for the same reason that residential real estate is a great asset class and why everyone wants to own a home. Everyone needs a place to lay their head. So if you need a place to sleep, you need a house, the demand is there as long as the population's growing. Commercial real estate beyond the multifamily includes things like industrial, commercial, development sites, utility scale real estate investments, infrastructure type stuff. Those are all different types of commercial real estate. And those are much more subject to market forces. My personal investment thesis is, while having diversity in the type of real estate that you own is good, multifamily is the backbone of any really solid real estate empire. Because to get to the point where you'd be isolated from market factors in the commercial real estate market, you'd have to have an astronomical sum of money, right? To own a true Class A office building in Manhattan that's untouchable even by the pandemic, because of course Google wants nice offices, you have to have $1 billion to own that building. That's not the average everyday person. When banks are lending for commercial properties, they understand all the market forces at play behind commercial real estate. And because of that, they price in risk. So first of all, the rates on commercial financing are generally higher than the rates on residential financing. The rates are also typically much more variable. So a bank might make a loan on a piece of commercial real estate on a 20-year amortization, but the rate is only fixed for a 2-year period of time. They know that interest rates fluctuate and the bank doesn't want to bet interest rates are going to stay where they are right now for the next 20 years, but they'll bet and they'll agree with you that for the next 2 years, we're going to bet that they're staying over here. But in 2 years, if the rates change up or down, you'll have the ability to refinance. We'll have the ability to adjust the rate if you don't refinance to whatever the market rate is then. It's the variable rate financing where the interest rates go up. Let's say the interest rates go up and at the same time, the demand for your particular type of real estate goes down. You can't service your debt anymore. You get foreclosed, you get wiped out, and that's the end. The beautiful thing about residential lending in the United States is that the government has decided that they don't want the ordinary person to be subject to that kind of risk in most cases. You can still get an adjustable rate mortgage, and the rates will be less expensive, or lower rather, than the rates will be for a fixed mortgage. But most residential lending in the United States happens on a 30-year fixed rate basis. And there are no commercial loans available where they will fix your rate for 30 years. If you know anybody, please, for the love of God, call me. I want to know. But no one does that. But the banks have kind of agreed, the government has agreed that for the sake of the stability of the housing market and for the sake of the stability of this asset class, and because from a public policy perspective, we want people to be able to own homes and we want that market to be stable, 30-year fixed rate, bundle it, sell it, government will even insure it in some cases. So it's a win-win. For a person who's not high net worth and for a beginning investor in real estate, commercial real estate is rarely the right answer because you're immediately subject to market forces, right? The great thing about buying multifamily but still residential real estate is that it is easier to get a loan for a multifamily house than it is for a single family house, substantially, because all of the income that you get from your tenants is treated as income to you for a debt to income ratio analysis that your bank will do when you buy a house. Traditional residential real estate buying, you're going to put 20% down and figure that your closing costs might run 3 to 5% of the total purchase price. But that's a lot of money if you're buying, a $400,000 house, right? You have to have $100,000 cash for conventional financing. But again, because the government has decided that as a matter of public policy, we want people to own homes and we want this to be a stable market and we want lenders to lend to this market, they've developed a set of guidelines and a special program to allow people to buy real estate with less money down. So the two major programs that are available to every American are the FHA program and the VA program. But the VA program comes with a caveat, which is that you have to serve in the military. Presuming that you are not a veteran, and the VA program is extremely strong, and if you are a veteran, that is a great lending opportunity to take. If you're getting an FHA loan, that is a federally insured loan where you only have to put down 3.5% on the property. So what that means is that in order to buy a $1 million house, you need $35,000. That's a lot of leverage. One of the other features of commercial real estate lending and borrowing is that typically a lender will not lend you more than 70% loan to value. So on the residential side, they'll loan you 80% because they know you need a place to stay and you're not likely to default, right, if you can help it. On the commercial side, they're like, well, we need to adjust for these market factors and we'll only give you up to up to 2/3 rather of the money. So being able to get 96.5% leverage on a 30-year fixed rate loan is literally unheard of in the commercial real estate world. It will never happen anywhere, but it's available to all of us through the FHA loan program.